podcast of November. You're with the Investing Education Academy co-founders, both myself, Brent Simpson, and Leon Noble. Today, we're going to be talking about the Fed's recent rate hike. Is it the last one? Is it not the last one? What does it mean for the market? What does it mean to you? A lot of these things are going to be very important over the next months to come. So, if you aren't familiar with the rate hikes, you definitely want to tune in. If you know someone who's been recently looking for a home, take out a loan of any type to get into the market, it even affects cryptocurrency. If you are interested in knowing more about what's going on in the market, tune in, share it. And I'm going to do a little bit of housekeeping while Leon tells you why we chose this topic.
Yeah, so we've been talking about this topic for over a year. Well, a
Actually, it's
year.
going on a year this month.
Yeah, we've been talking about this topic. We started talking about this topic November of last year, 2021, when the Federal Reserve first started raising rates. A lot of people before this had maybe never heard of the Federal Reserve, did not care about the Federal Reserve. I know I didn't. I mean, I know I was aware of them, but I've become intimately aware of what the Federal Reserve does now, how it affects all of our money. And one of the reasons we've been talking about this so much is because the turmoil we've seen this year in the market is 95% caused by the Federal Reserve and what they're doing with interest rates. And so we beat this horse all year, right? So we're not going to go into the ins and outs of it, but I just want to tell you what happened today. So today was what they call Fed Day. In the world, the geekdom of the financial markets, this is a huge day, Fed Day, because they're raising rates. And so what happened today was, and I posted this inside the Facebook group and inside our membership platform. I said, hey, three quarters of 1% raise by the Federal Reserve, or 0.75%, which is a massive raise, by the way, for the Federal Reserve. This is the fourth one in a row, by the way. They did that, three quarters of a percent raise. But I made the point. I was like, I was like, that was expected. What changed was their statement. So after they put out a raise, they say with the raises, they usually put out just a small statement, and then Federal Reserve Chairman Jerome Powell speaks. Well, this statement caught everybody's eye, right? Because again, in the world of finance, anything the Fed says, does, looks at, what have you, everyone parses every small little bit of it. And they put out the statement they'd never said before. And the statement basically said that the Fed was now going to take into account the results of the previous raises they'd done, right? And the reason why that was big was because prior to that, the Fed had said nothing but we're going to crush inflation, and we don't care if we run over your money and your account doing it, which they've done for all of us, right? But this statement was the reason why the statement caught everyone's eye, because what it said to everybody was like, hey, the Federal Reserve may actually kind of digest what they've been doing and seeing that, okay, the economy is slowing, housing is basically dead, anything that requires debt, car loans, housing, things that even personal loans, all that's basically died, right? It's all stopped because rates have gone up. Like, for instance, right now, I actually just sent it to a friend of mine. Shout out to Adrian. I sent him a screenshot of the average rates for used cars right now are 10.6%. 10.6%, the average rate for a used car. Right now, the rates for mortgages on homes, 30-year mortgages, are a little above 7%. A year ago, they were around 3%. So they've more than doubled in a year. So the reason I'm telling you all this is because the Federal Reserve has kind of just been on like an automatic pilot, raising rates every month. Today, they came out and said, hey, we're now seeing that what we're doing is actually working, right? So we're taking a breath of what we're doing. And what everybody read is that the Federal Reserve is now going to possibly slow, not stop, but slow the rate of increases. Again, they've been doing 0.75%, 0.75% raises the last 4 times. So if the Fed then stepped down and say 0.5% or 0.25%, that would be huge, because that's slowing the magnitude of the rates, and that will eventually lead to the Federal Reserve stopping raising rates. So came out with this statement saying they're now going to take a breath of what they've been doing. Market loved it. The market was like, holy S, they finally have, they're going to maybe put the brakes on things. take a look around, see it's actually making a difference, and they may slow the pace. Well, yo, Mr. Jerome Powell came out in his conference, threw all types of cold water on that. He came out and said, because what everyone was hoping for was a slowdown into the end of this year, and then what they call a pause first quarter of next year, which means January through March they wouldn't do anything. They would just let the rates that they've raised sit and see how the economy acts. So everyone was looking for this pause, this pause language. Powell explicitly said we are not even thinking about a pause. We're nowhere near. We're nowhere near. We're nowhere near what they call there's a term called terminal rate. Terminal rate is where the Federal Reserve will stop raising rates. Powell said we're not near a pause, and we're not near a terminal rate. He also came out and said that the rate that they anticipate the terminal rate being, I think like 3 or 4 months ago, is now going to be higher. And the reason they said all this is because they had anticipated that that inflation would come down a ton faster than it has. So they started raising rates back in March. Inflation was like high nines, 8%. Inflation today, 6-8 months later, is still in the 8% range. So what they're saying is like, yeah, we've made a difference. We've started, but we're nowhere near their target. Remember, so I know everybody knows their target is getting inflation down at 2%. Inflation right now is 8%. So it tells you how much work they have left to do. So what happened today was there was a total fake out. That statement came out right about 2:00. The market shot up, and I was like, oh, finally! Like I was with everybody else. Man, then I watched that conference. My man just poo-pooed on everything. He was like, no. And the funny thing was, one of the reporters was like, hey, Jerome, the bond market and the stock market are reacting favorably to what you said. He didn't like that. You could see on his face, like he was almost like, oh, really? And then he kind of went down the path of, let me tell you what we're really about to happen. And that's when he went down the path of we're nowhere near, we're not stopping raising anytime soon. We're nowhere near the terminal rate. I just want to make a real quick point of why Jerome Powell does not want the stock market to rise. Reason is because there's something called the wealth effect. And remember, the reason he's doing this is to slow our spending, because our spending is causing inflation. So when the stock market rises, there's something called the wealth effect, right? We all feel, we pump our chest out because our accounts are looking, bold, and we feel like we have more money than we actually may have. So we may go out, take out loans, or pull cash out of our accounts and go spend because we know we have our stock account to fall back on. Well, that's called a source of funds. He doesn't like that. Another thing is that if he stops, if it becomes known that this whole rate cycle is going to end, without getting too wonky, what's going to happen is people are going to start buying bonds again. And when you buy bonds go up and rates go down. He's raising rates, so he wants to keep rates high, so we stop borrowing money. So he does, and those two things kind of happen kind of together. Stock market goes up, and bond prices go up, and then interest rates go down. So Jerome Powell does not want to see the stock market go up. That's why he was quick to throw cold water on what was perceived by the market to be, hey, it's a green light to buy stocks again. So so that was what happened today. That was the major thing that happened in the market today. I've made a point the last month or so that, in my opinion, again, just my opinion, not saying this will happen. My opinion is that we're kind of near the bottom of this current drop in the market. And the reason I said it is because I'm just going off historical norms. In bear markets, the market typically drops anywhere from 20 to 30%. The market so far at its peak was down about 25%. So we could, and right now I think we're down like 20%. So we could still see another 5 to 10%, down-ish maybe. But I definitely don't see another 20 to 25% drop. So I think we're kind of near the bottom of this current drop. And I've been telling Brent and I've been telling our members, our community members, as well as people just we talk to, and myself, is that I've been buying slowly and small, buying back into the market the last month or so because I believe we're near a bottom.
Yeah, Leon's a little more bullish on the market than I am, believe it or not.
Right.
I still think we have ways to go down. However, I am dollar cost averaging back into the market as well. And, I think the biggest thing for everybody to understand is that this is also going to affect the real estate market pretty heavy. When you start looking at these interest rates and you're thinking, oh, okay, a house is maybe 6-7%. By the end of all these rate hikes, you're probably going to be looking at interest rates on houses being anywhere from 10 to 13%. And this is just my prediction from historical data. But what they don't want is this bubble happening where everybody thinks that, we have this store of wealth where, our accounts are here. We can just liquidate it anytime. We keep spending, spending, spending. And then we keep borrowing, borrowing, borrowing. And then all of a sudden it's massive defaults because no one can afford. And that's why they're raising rates. That's why these things happen. They want to slow the economy because people get carried away. And we think that money will just continuously grow on trees and we can just borrow to our heart's desire. Also, with the housing market, you got to think it was a time where predatory loans really reigned supreme, and those loans were coming in 2-3%. So people were buying what the biggest house they can get because they thought, oh, the interest is so low, I can get the biggest house I want. But then when things started to change and the reality kicked in that there's a mortgage with these, people started defaulting on loans. As the interest rates of other things became more expensive, they can no longer afford. That tipping point happened where like general goods, basic goods that they needed conflicted with this mortgage of a house that they didn't need. And then all of a sudden, all these houses in foreclosure. That could happen again. I mean, we could be looking at I'll say in the next 6 months, an environment where there's going to be a larger number of foreclosures. Leon, I've seen it. I'm not sure if you've seen it, but houses are staying on the market longer. You're starting to see people do reductions in price, and that's because interest rates and housing prices have an inverse relationship. So as these rates continue to go up, it's going to be inverse to the price of these houses, and people who are going on the market at 600,000-700,000, depending on where the house is, they're bringing it down to like 560, 570, and there's closing help now. 2 years ago, closing help was like an insane thought. No one was giving closing help. It didn't matter. You can put your house on the market at the top of the market and somebody will buy it. That's changing. So, as we look at what's happening in the stock market, you have to understand that in the real estate market, both really real estate and housing, I'll say, there are going to be a lot of opportunities to buy if you're in a position to buy. Unfortunately, for those who are not planning or maybe listen to these things thinking Leon and I are just blowing smoke, that wealth gap is going to get a lot bigger. The one thing I can say is that we're going to be on the other side of that gap as it happens because we're making plans. And so, with that being said, Leon and I for I'll say Investing Education Academy is entertaining creating a fund because a number of people have said they want to invest directly with us. So we're entertaining that thought. Additionally, buying real estate internationally, we've already done it. We're looking to go back to acquire more properties later, either this year or next year on the west coast of Africa. And we're also looking, there's a deal been presented in the northern part of Africa, right under, just the northern part of Africa. Just leave the cliffhanger. So our investment group is continuing to move some of our money towards real estate while continuing the dollar cost average in this for sale environment in the stock market. But one thing I do want to say, and Leon, I open this up, like, let's quick discussion on it. I don't see the stock market recovering in a rubber band effect. A lot of people are thinking, oh, as soon as the Fed stops, it's going to snap back to where it was in 2020. I don't think that's going to happen. I think it's going to be a very slow recovery. And the numbers that you're seeing, the market's not going to move too far away from these lows in any type of a fast fashion.
100% agree. And the reason is because right now rates are, and I'm just going to quote what's called the Fed funds rate. That's the rate that the Federal Reserve raises. As of today, that's at 3.75. We'll just say it's at 4%. Say 4%. Their goal is to get that to 4.5 to 5%. Now, what that means is in the real world, for us, just add 6 points to that, and that's basically what me and you will pay typically in credit card, any sort of loan, right? That's why car loans right now are like 10%. Add anywhere from 3 to 6 points to that. So car loans are at 10%. Housing is at 7%. So the Fed funds rate right now is at 4%. They want to get that to about 5%. And the reason I agree with Brent on the stock market not rocketing back to its highs is because Jerome Powell said that once they get to that terminal rate, which would be about 4.5% of the economy, they're they're then going to freeze it. So when they get to that Fed funds rate, 4.5%, 5%, they're then going to hold that rate there for the foreseeable future, right? So rates are going to remain high for at least a year. Only way that's going to change is if the economy goes into a deep recession and they have to start cutting rates. But rates are going to remain high, which means bonds are going to be a very strong competitor to the stock market, and is going to pull. I mean, we've been talking about inside IA about the I bond. It was paying 9.5% a month or two ago. Now it's paying about 6.8%. I think I recently posted, and that's for 6 months, right? So you can lock in 6.8 to 7, maybe 7% in 6 months, half a year. It's great. So that's competition for the stock market. And then of course your treasury bonds, the 10-year treasury is trading at about 4%. So you can go. So basically, what I'm saying is bonds will remain a strong competitor to the stock market to when the Fed starts cutting rates. Who knows when that is? But I agree with Brent. It's going to be for a while. So that's going to keep the stock market check. Not saying the stock market's not going to go up. Stock market will go up. I just don't believe, as Brent said, I don't believe we're going to see that 2020, 2021 rocket higher that we've all gotten used to the last 2 years. Because prior to 2020, 2021, that's not how the stock market worked. I mean, really, prior to the great financial crisis in 08, 09 is kind of what we're going back to, which is when the market generally returned 8 to 10% per year, and not I think it was 16% per year from 2010 to 2020. That was like outside the norm because interest rates were zero. So in order to get any sort of return, you had to go into the stock market. Well, now bonds are now, I think it just had a freeze. So therefore, there is competition for the stock market. So say all that to say, continue to invest in quality companies, dividend payers, big name household names that always do your research. Just because you like the stock or the company does not mean it's a good investment. You still got to do your research. But yes, agree with Brent. Stock market, I don't see us going back to highs anytime soon. But I do see a recovery, slow grind, as Brent said, grind up once the Fed stops raising rates.
Yep. So with that said, everybody, and if you're looking to get more information like this, you can go to ieanow.com and join our community. We have a really significant announcement to make. We'll probably make it 1st of December, maybe 1st of December, or at our next meeting, we'll make the announcement about one of the areas we're moving into. But gotta stick around to see. Dear, but with that being said, we thank everybody for listening. We thank you for listening to the podcast. We're getting like 6,000 unique downloads per month. So, that's awesome. And for the community members, we hope you're using this information. If you're looking for our 2-stop picks, they are now only available inside of our membership platform. And we're still continuing the conversation about what's happening in the market in our Facebook group. So feel free to join our Facebook group. It is free. There's definitely conversations about what's happening in the market there. And we look forward to seeing you on that side. Everybody, have a great day.